All right. So today we are joined by Steve Frost from National Mortgage Funding. We're going to talk about, Steve, some big topics that I think are having a big impact on the U.S. housing market. But before we jump into that, welcome back. How you doing? How's the week been?
It's been great, man. I tell you, the last few days have been a nice relief from every day looking at interest rate sheets and quoting rates to people, and then helping them pick their jaw up off the floor and all that stuff. So it's finally it's been a good week. So
Yeah,
no
that's
complaints,
great.
man. Thanks for having me back.
Absolutely. Yeah, and we're going to get into that later in the show because we're coming off of last week where rates went over 7%, and then this week I think it's a different story, and so we'll talk about that. So, first I
Yeah.
want to get into this whole debt ceiling thing. It's probably on every major media outlet, it's on every headline. What we want to know, Steve, is how does the new deal that the government made impact mortgage interest rates specifically?
So I mean, good question. That how does the new deal impact interest rates? Like it's the fact that there is a deal that impacts interest rates, right? And so we've had there's a lot of volatility in the market, like we know that. And as the debt deal got closer and closer, like everybody knew, every pundit, every politician, everybody that has skin in the game of this is like, yeah, we're going to get a deal done. But the markets just didn't believe it. And so what happens is you get Moody's and you get some of these other ratings agencies out there, and they start downgrade or threatening to downgrade uh, American bonds or treasuries, right? So what does that mean? Like they're basically giving them a bad credit score. They're like, hey, there's not if this debt deal doesn't pass, like there's a possibility that we're going to downgrade United States debt or treasuries to a worse credit score, right? So
Yeah.
America's about to get a 680. Like it's not terrible. Like we're not over here like North Korea country, but we're about to get a 680. And so when they start talking about that, the bond market immediately just starts saying like, we lose liquidity, and so they have to start increasing the yields the same way that it happens with inflation, right? Like in order for people to buy these investments and have them be considered long-term safe investments, they've got to raise the rate of return to get people to buy them if they're threatening the value of those bonds to possibly lower in the future because of downgrading our credit score. So as the days went on and we got closer and closer to this thing, because we're still going to make it by like the skin of our teeth, right? Like I
Right.
think
Yeah.
they said the government runs out of money or we can't pay our bills on June 5th, which again is a fallacy. Like there's all
Right.
kinds of other, like this happened before. Do you remember when they closed like national parks? Like they closed federal museums. They did all these different things. They closed all these federal offices, which is just kind of like a show of like, here, we're going to like stomp in our sandbox. I mean, there's ways to make all these things work, right?
Yeah,
And
and let me
so,
just jump in really quick. You said something to me. We went on a nice little family, a double family vacation, your family and my family last weekend. You said something to me when we were sitting next to the water slides about. Well, you said that this is just a manufactured story. There's no way that the government doesn't get this deal done, and you were spot on. I forget who I was watching. I was looking at one of these hearings in Congress, and there was never going to be a world where we didn't figure that out. It was just a matter of what it was going to be. And so now that we
right.
have, I digress, keep rocking and rolling. But I just think it was funny that all these YouTubers are, U.S. is going to file bank. It was never going to happen, not ever.
No, not at all. And there's even some of the things going around there, like some of America's wealthiest citizens are worth more money than America has cash, right? And so you look at like our Treasury cash reserves. So like it's such an apples to oranges thing. Like if you really think about what headlines are, of course, Elon Musk is worth $192 billion, right? Like as he's now the wealthiest man in the world as of yesterday, thanks to Tesla stock going up after he met with
That's right.
China. Bop, 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 all these things happen, right? But Elon Musk can't go to the ATM and get 192 billion dollars
That's
out of the
right.
bank. Like, and there's tons of story. Like, there's been a lot of headlines, and that's just how like really really wealthy people work, because they have money tied up in assets that hold value, and then they borrow against those assets, and then sometimes they'll sell them to pay that back and do that kind of. So again, it's just like nonsense headlines. The problem is that when you get these ratings agencies, that's when it really started to hurt us. So all those things are going on, and then while we were gone this weekend, we were was it Sunday morning? We went and grabbed coffee. I'm like, well, they reached a tentative debt deal or reached a deal in principle, and now they're gonna move forward like we knew they were going to. And the reason that it takes so long is that they were going to 100% reach a debt deal. That's the easy part, but the hard part is all the other political agenda BS that they pack inside that. Because what that
Right.
is it's a deal. And so they pack in there like clawing back COVID spending, and they wanted there was even mention of them bringing back some of these FHFA mortgage changes, like the Biden benefit to people with worse credit, and all kinds of things. Like they took back that $80 billion that was earmarked for the IRS, and they changed like some defense spending, and so they pack it in with all this other political stuff. This happens all the time. That's why they had such a problem, and that's what they were negotiating, was all the other nonsense. Like Joe Biden and Kevin McCarthy are like, yep, this is cool. Like we need to do this for our debt ceiling. We need to raise it. We need to do this. We'll set these cap. Okay, perfect. That's fine. All right. What about all the other BS for us to sign this bill?
It's
And
a great
that's
point.
literally all.
Yeah.
So as soon as
So
that happened, we saw rates go from interest rates, like the bond market, they go in, it becomes a liquidity issue, right? Like nobody wants to buy these things. And if the thought of actually going bankrupt happens, people are going to buy into these like these shorter term investments. So your long term mortgage backed securities and 10-year treasuries, those markets get hit worse. There's less liquidity. You have to raise your funds, raise your returns to get people to buy them. So
and that's
I'm,
what happened last week, real quick, right?
yeah. So we're looking at rates, dude. We were at like legitimately in like 7.375% to seven
Yeah.
and a half percent on 30-year loans at the end of last week. And then yesterday I locked two loans at 6.625% with no points. We got a little bit, and we'll talk about it more later. We lost a little bit of that today because of some of the jobs numbers that came out. But again, I think that as the market continues to digest some of that data, that I think it's ultimately going to be, it'll ultimately come back and go back to, again, following technical data, right? Rather than following the emotions of these markets.
I love it. Well said. You nailed it, because I was going to say the same thing. When we talk about mortgage interest rates on the show, we often say, mortgage rates follow inflation, and here's the data that we're looking at every week, every month. And, pending any weird things that happen in the market, the debt ceiling negotiation was one of those things that kind of just threw us off for a couple weeks, which spiked interest rates. Now that bill is in place, do you think that the mortgage rates moving forward, the trajectory looking ahead, kind of gets us back on track with where mortgage interest rates will start to go, which is that trend downwards over time as inflation comes down?
Exactly. So we call like a return to technicals, right? So, I mean, the bond market and the mortgage-backed security market were like wildly oversold for a very, very oversold for a couple weeks, really, all because of this. And it's just funny because the people that trade these bonds and that determine these prices and make some of these things work the way they do are some of the smartest people in the world. These are the best financial minds in the world, and they follow these headlines. So now we're going to go back to looking at a lot of data, and a lot of data has really been going in our favor as far as inflation goes. Today, the employment report wasn't great, although the unemployment, we created a lot of jobs, but the unemployment rate actually went up, which is kind of interesting. So it'll be interesting to see how they analyze that.
Interesting. Cool. All right. So let's switch gears for a minute. And before we get into the next topic, for any real estate professional, Steve, that maybe needs a better loan officer to partner with, what's the best way for people to get in touch with you?
So we'll put a link below this. With just email me or call me, and I've got a team of people here that will make sure we get you taken care of and get you the advice that you need. We're licensed in Michigan and Florida. We're adding more licenses as we go, and so that anybody that's dealt with the financial regulatory affairs, you will know that is not an easy undertaking. But we've got partners and things like that. We'll always make sure we get you good advice and head it down the right road.
Yeah, awesome. And I'm not even going to call this a shameless plug, because I believe Steve is the best loan officer in the country. He's proven it time and time again. He continues to service our team here in Michigan. So yeah, if you guys are real estate professionals, you're looking to partner with a phenomenal team to provide your clients with the best service, talk to Steve, get an idea of what it is that they do and how they can help your business. And I think you'll be glad that you do. So let's move on to our second topic. And that is, there's been a lot of, we'll call it noise around this 1% down mortgage that Rocket Mortgage just launched. And to your point, many lenders have been doing this. It's not just a Rocket Mortgage thing, but that has brought up, Steve, a lot of questions. Is this good? Is this truly a good thing for the consumer? Is it a bad thing? So I wanted to kind of pick your brain from a lender's perspective, from a mortgage guy's perspective. What are maybe some of the pros and cons? We'll start from your perspective, and then I'll get your advice from the borrower or the buyer's perspective on, do you think that this helps in the marketplace?
Sure. So, I mean, really, there's in my if you qualify, there is zero con, right?
Mm,
And so, if there was a con, right? So, in all the lender, and there's several lenders that are doing this now. They're calling it 1% down, and what they'll do is there's a cap, right? So it's 2% up to a certain dollar amount, whether it be $4,000 or $6,000. So that would be 2% down or 2% down payment assistance up to a $200,000 home, or 2% up to a $300,000. Depends on which lender you're working with. And this is entirely subsidized by the lender on conventional loans. So these lenders are giving you, it's just a super simple lender credit. And
mm,
there's, like, and when you compare it to like traditional, like, so they're calling it down payment assistance, right? Which normally down payment assistance, there's it's not, there's no real free money, right? And so with
right.
down payment assistance, there's either, a 10-year period where you have like what we call a silent second mortgage, where there's like a lien on the back end of your house. If you try to refinance or sell, you pay it back. Some of them stay on there for the life of the loan. Some of them you make payments, some of them you don't. All kinds of different things. This is literally like a lender credit for up to 4,000 or 6,000 or whatever percentage it is, right? For that amount with no strings attached, which is,
Wow.
there's no such thing as free money other than this, right? And then there are some flaws in it, that because people always find a flaw, and I respect that, and that's fine. And the drag or the downside of this is this is designed for people that make up to 80% of the area median income, right? So depending on where you're located, and you can Google, conventional loan area median income, we call it AMI. And so like in Oakland County, where we work out of, the area median income here is like $90,000, $90,800. So if you make $72,000 or less, you qualify for these products. And so it doesn't, and that's the interesting part. And they're very open about this. Is there, you don't have to use all of the income that somebody makes. So if somebody just has
Mm,
a base salary of 70,000, but maybe has 80,000 in commissions, we don't have to use the commission income. We don't have to use both borrowers' income. So there's some ways that you can manipulate that. And yes, it does limit who gets the money. They're not giving people $4,000 to buy $1 million home, and that's not going to make or break that $1 million home purchase. But for $200,000, that $200,000 buyer range, which is so competitive right now because home prices are so high. So some of these entry level markets, that can really make or break somebody, whether it's covering some of their, maybe they have the 3%, right, to put down,
sure.
but this gives them some extra money to cover some closing costs. It gives them some extra money to buy some new things or help them with moving expenses, or maybe it helps with some appraisal gap or appraisal guarantee coverage. There's all kinds of different things you can do to money that has no strings attached, other than you have to make less than 80% of the area median income. And I should mention this too, you have to have a 97% loan to value, right? So if you want to put down 5%, or you want to put down 10%, or you want to put down 20%, you can't use this product. You have to borrow at least 97% of the value of the house, right?
Got it. Are
Um,
there loan limits to this?
yes and no, right? So there's not a loan size limit to this, but if you're making 72 grand a year, you're not getting a
Okay.
$500,000 loan. you know?
Got it. So
So
let's
like
go ahead.
300 is about the max, you know,
Okay.
and these things change. Like if you're in San Diego, California, this might be, it's a whole different number. I don't know it off the top of my head, but it could be a totally different number, totally different loan amount just because they're adjusted by county.
Yeah. Yeah. Well, yeah, I guess to your point, this is a great thing. I mean, if you look at it because of the income piece of this to qualify, in my head, this only helps things. I don't know why there would be a downside and why maybe there has been some backlash in the market around this new mortgage option because it's a great thing. And to your point, it's for the person who's putting 3% down on a conventional mortgage and they're getting 2% of that essentially back as a lender credit, correct?
Right. Yeah.
Yeah.
And I mean, there's some rumblings of like, oh, this is how, like, what caused the how, like, look,
Right.
4 grand,
Right.
$4,000 down payment assist isn't going to make or break the housing market. If everybody got it, it's not going to
Yeah.
make a difference. The last time the housing market crashed was because when we were doing zero down loans, you were doing a first loan for 80% at 6.5% or whatever it was, and you're doing a second mortgage for 20% at 9%. And you're doing it with stated income. They didn't have to have reserves and they could be working, you know, like the guidelines.
It had more to do with the payment adjusting than what they were putting down. So that argument
Exactly.
doesn't even play because yeah, you're right. Like when we were writing those mortgages, two things were happening. Either A, it was an adjustable rate mortgage and the person's payment doubled overnight in their 3-year adjustable period. They didn't know that was going to happen. So that crushed people's ability to make their monthly payments. And then B, it was a negative amortization product where they were tacking on principal, owing more on their house every single month without knowing that. They took a mortgage out for 200,000, woke up in 3 years. It's like, well, you actually owe 275. What? How do I? Because you weren't even covering the interest, Bob. Well, no one told me that. That had nothing to do with down payment. So if that's the pushback, and I think you're exactly right, this is a phenomenal thing. My question is, can a buyer use the credit to buy down a rate in this product? Can they use the credit for that?
Yeah, it's simply so if you have all the money, right? So if you're buying a $200,000 house, let's say on average you need 12 grand for closing, right?
Okay.
So closing costs, setting
Yeah.
up your escrow account, your 3%, like all your stuff, you need 13 grand at closing. So this is just simply reducing that by $4,000, right?
It's
So
amazing.
I did the first one of these that I did. I actually used like 2,700. We had the down payment, but we were running into some debt to income ratio issues, and so we paid off a credit card with we paid off a credit card at closing by having that extra cash, which dropped money out of their payment. It wasn't the debt wasn't that it wasn't super tight for them as a household, but for that one borrower it was. So we had to kind of squeeze that borrower into this 97% program because they were a first time home buyer and their significant other wasn't. So to get them better pricing on the loan, we called them a first time home buyer, left her off the loan. And then, I mean, there's a bunch of back and forth, but we utilized some of that money to pay off a credit card for them. And it was just a credit card that they would have had if they would have closed, but instead we got some free money. They used $1,300 to help them at closing and $2,700 to pay off a credit card and
It's
made the debt
phenomenal.
ratios work and allowed them to take advantage of all the benefits that come with some of these programs because not to go super deep into the weeds, right? But on these 97% loan to value loans, which are pretty common right now, there's a couple things you keep in mind. Like, well, maybe people should put down more money. And I get it. That's fine. Like I put down more on my house and you did the same. But when you look at the numbers and, when you're a first time buyer, like I'm not a first time buyer, nor are you. But when you're a first time home buyer, you say, okay, I have 5 grand here, or I can put it down on my house. And the difference is $30 a month, right? So
Right.
if I'm dividing my 500, right, to simplify the math by 30, like it's going to take me years and years to break even on that money. So what I've done is I've gone ahead and buried my 5 grand, you got to call Steve and pay about 5 grand to get it back. Or
Yeah.
you can keep it in your pocket for $30 a month and subsidize yourself. But so it makes a lot of sense to do these lower down payment loans, right? So that's one thing. The other thing is to qualify for these loans, these 3% down and these first time home buyer deals. We talked about this a couple of weeks ago where all those loan level adjustments where you're being charged, with a little bit lower credit score and you've got to pay more points and for less money down, you're doing all these things. Well, the first time home buyer products that we're talking about that use this free money also it waives all of your loan level pricing adjustments. So that's why it's so important to get people, why I'm always trying to find a way to split applicants and do different things to make sure we take advantage of these first time buyer products, or, under 80% of the area median income, because we can waive a bunch of these extra fees. So it's not that we're trying to get people in by the skin of their teeth. We're just trying to save them as much money as we possibly can.
I told you guys, Steve's the best loan officer in the country. Like all that stuff you just said, all I'm thinking in my head is like, wow, that's just a bunch of Instagram reels that people just need to watch, because you just dropped so many nuggets. Like you guys should go
Yeah.
back and rewatch that. So yeah, dude, like I'm just like, you continue truly, whether we were recording or not, you continue to impress me with your art, because it is an art. Like,
Yeah.
and that's the difference between a top loan officer and then the rest of the mules, the rest of the amateurs. So anyway, I'll thank you
And
for
first
that.
time buyers, right? Every $1,000 is such a big deal, Like when you're
Yeah,
buying a house, I mean, those, you need every one of those nickels.
it's amazing. All right, so let's talk about unemployment. That I think that just came out this morning, which is a heavy indicator that impacts mortgage rates. So, what was it? What happened? And then tell us about how that affected rates.
Yeah. So, when we talk about what the Fed's doing, and, we're like, okay, so now it's data driven, right? So before they were just going to hike rates, the language was like, we were going to continue to tighten monetary policy until we can't squeeze any more out of the rag, right? So now we've got like banks, which will be interesting. I think now that the debt ceiling is done, I think we're going to see more of these regional banks hit the news cycles with some more of these regional banks
Sure.
going under, which is a bummer, because that is all like, that's where all your commercial and business lending comes from. And we both know like the commercial real estate market is kind of interesting right now.
Yeah.
Uh, but anyway, so the unemployment report is one that we watch heavily, because we've done a lot with inflation. Like the inflation has come down significantly, and we're starting to see some of these pricing measures ease things, and all this. So these things are all working. But the one stubborn part of inflation that's really driving inflation is the jobs. Like we are still creating jobs at record levels. So today, economists were expecting we'd create 190,000 jobs, which is kind of funny because private payrolls came out 2 days ago and they came in at like 270,000
It's
jobs, but they
crazy.
thought that the Bureau of Labor and Statistics was like, well, we're going to guess it's 190,000. So came back today at 339,000, which would normally, being that out of whack, would just destroy the bond market for the day. And it really, it impact. It hasn't been great. We've probably lost like an eighth to a quarter of a percent, maybe in mortgage rates. But we saw the actual unemployment rate tick up. So we went from 3.4% unemployment rate to a 3.7, which comes from a different survey. It comes from like a non-government data driven survey. It comes from what we call a household survey. So, there's kind of like, I can't think of the word right now. Like competing data, right? Like one of them is
Right.
saying one thing and the other one is saying another. And so again, that's why the bond market hasn't really reacted that strongly to it. The other part of that we look at really closely are hours worked. So the hours worked decreased by 0.1%, which doesn't seem like that big of a deal, but you're talking about 0.1% of every job in America was
Crazy.
decreased by
Yeah.
that. And then we also look really closely at wages. And so wages, they stayed within and just a hair below what expectations were for wage growth. So we're seeing wage growth year over year, like 4.4%. And we want to get inflation down to 2%. And the reason that we look at that so closely is that inflation is between like, we'll call like 4.5% and 5.5%. However, which report you're looking at. Well, if wages are growing at the same rate, guess what's not a problem?
Mm.
Inflation.
Yeah.
Like if wage
Right. Right.
growth and inflation go at the same
Right.
rate, then who cares? Like
Yeah.
forget it. Like I'm just gonna keep buying stuff.
That's a great
And
point.
so, and what the Fed's trying to do is they're saying like they're in this pickle, right? Like they don't want to play. If you remember that game where it's like the tower and you put a Kleenex on it and you had to set ice cubes on there until they
Oh
fell
yeah.
through, So and you didn't
Don't
you
break
didn't
the ice.
yeah, is that what it was called? Yeah. So what a great name. So you're trying to figure out like how you can put all these ice cubes on here without falling through that. And that's what the Fed's doing. Like they've got to get companies to spend less money, but they don't want people to stop getting jobs. So they want the unemployment number to go up, but they want to do it very slowly. And at the same time, they're doing all these things, but people just keep hiring, and so that's been really the kind of the tricky part of tackling inflation right now is the last piece. We're starting to see everything else go our way.
Right. So looking ahead, what are the what's coming in the rest of June that will continue to drive this story of mortgage rates?
So next week we'll have CPI. Is it next week or the week after? It might be the week after. So CPI, so Consumer Price Index, is a really big one that we look at. We also are going to get Producer Price Index, which is the price that companies pay for the stuff that we buy, which is kind of like that's like the beginning of inflation. That's like where it starts to hit our pockets. So we'll be watching for that. And then we have a Fed meeting later this month as well, which I think I could be wrong is on the 17th. I don't have my calendar in front of me for that, but a lot of them right now, it's kind of interesting. We've been talking about raising, pausing, cutting, and you see all these things. And now there's a new term that's been introduced this week, and because they're saying that, okay, so they've been raising rates. And this meeting, they're thinking that they're not going to raise rates. Like, so there's a good portion of these Wall Street bettors that bet on they're going to raise whatever they're going to do with the rate. And a lot of the pundits are saying that they're not going to raise rates this time. So the Fed came out and said, yeah, we may not raise rates, but this is not a pause. This is a skip. So we've added another layer to this. So that's kind of what the markets are looking at. And I think that the consumer price like this unemployment report definitely lends itself to more raising rates. But I also think that as we see some of the other inflation data, because of what we've seen for rents and housing costs and stuff like that are coming down, I think that CPI and some of those inflation reports should probably push us more in the direction of like the skip or the pause position on rates later this month.
Steve, we appreciate you. Thank you for all the insights. Tons of nuggets that you dropped on today's episode. So thank you for that.
All right, you got it, man. Have a good one.